Hi guys, welcome to the SavvyMoneyShow with me, your host Sean. Now, we're going through my ETF. Didn't think I'd have to rebalance for another month, yeah? But on further look, I found out there were sectors I didn't have covered. So, EPD, 8.44%. I'll also say why I didn't put others in as well. Enterprise product partners, right, their pipeline and oil carriers, and I'll speak more about that later. REIT, national health investors, they have come down a lot. You know, I mean, they come down $20, and they are in a good PE ratio. They're in a good sector, the health sector. They give us 6.46% dividend. Now, Motley Fool's 3 high yield stocks at rock bottom prices. And since last year I've been speaking about them. Kraft Heinz. Well, if it's good enough for Buffett, it's good enough for me. Now, it gives a 4.4% yield, which we will get a slice of. Yeah, it is one that's undervalued in my opinion. You look at the enterprise value and the market cap, a forward PE, and the price to book is under 1. You know, what can you say about that? Ashmore Group is a company that has a PE ratio of under 15, and it pays this dividend, a share of 4.1% dividend this month. And for those of you with UK ISA, with this in, you don't pay tax on the dividend. Now, Gazprom. I've had a few people say about Gazprom. Gives a dividend at 6.99%. PE ratio is 1.72%. You know, is diverted from gas producing into the pipelines and gas storage. And we know from last summer how gas storage, when the Contango, how lucrative it could be. Now, it does have a sanction on one of its line deals. If that gets removed, it could really move. But even if it doesn't, it's still good value. Sylvian Platinum is there because I was looking into it. It has a special dividend coming up, but that didn't make it, sorry. BHP, UK mining company. The PE ratio is fairly high, but it has a dividend that allows it to get into, it has a good dividend that allows it to get into this. NetApp, now it has a 3% dividend and PE ratio, and I think I need one in this sector. Gilead. Now, the thing about Gilead is people think because of the vaccine we don't need the cure anymore, but you're going to need because of we don't need the treatment because we've got a cure in the vaccine, but we're always going to need the treatment. I bet you the cruise ships will need to have doses of this on board. You will get places that will need to carry this to open. You have the anti-vaxxers who won't take the vaccine. You know, and I remember doing a video when they were first coming out that even with the without the COVID treatment drug, I valued them at between $50 to $60 a share. And look at that enterprise value now. Is now 30 billion above its market cap because it has the treatment on its books. Now, it gives a 4.63% dividend. I just think it's worth it. Now, Morrison's, I've spoken about before, 16 PE, not very volatile, 4% dividend. Why? Amazon Whole Foods in the UK is picked and chosen by Morrison's. They have a contract with them. They have contracts with a lot of other companies as well. So anything you order from Amazon Whole Foods in the UK is actually supplied by Morrison's. Brexit. I know we're tired of hearing about Brexit, but if you go to Morrison's to do a shop, Morrison's not only has foreign food, they also have UK food on there, a whole UK range on there as well. So you will have, they have their suppliers already providing UK food. You go to the likes of Lidl, which do cheap food, and nothing against Lidl, you know, who doesn't like a chainsaw when they go grocery shopping, but they do it, blueberries from Chile and places like that. Don't forget to hit that lovely like button, and don't forget the sexy subscribe button. A lot sexier than me, just ask the wife. And if you want to be a hero, hit the bell notification. You'll be notified when a new video gets uploaded. And why not check out the links in the description below. If you're looking for a free trading platform, you get a free share worth up to £200, depending on the platform you use. If you deposit a small amount, why wouldn't you? Yeah. I'll see you in the next video. I wanted a supermarket chain. It was a toss-up between Tesco's and Morrison's. I had Morrison's last year. They've done incredibly well this year. I remember Tesco's had done, they were kind of hanging by the fingertips, so was Sainsbury's. I think Morrison's will be fine. Now, Lockheed Mine. I can't really, after my review of Lockheed Mine, where I found them to be $100 undervalued, I can't really not have them in. P ratio of 14. One of the lower payout dividend ones, that 3%. And I know we're we have missed this dividend, but do you want to miss the dividend, or do you want to get it a better price? You know, what would you rather? Look at it. The next one, the 7.78% dividend. Yeah, is Edenbridge. And then we move on to Medical Properties Trust, which is a 5.19% dividend, which will be paid soon. And I've done a video on them, so I won't spend too much time on it. I wanted a gold or silver company, and of course Mag Silver doesn't give a dividend, so there are. Goldfields I looked into, it's a 3.83% dividend, 10 PE ratio, which was good, but I can't get it into the ETF in trading 212, so there we are. So it was between Trans-Siberian Gold, which has an 8.48% dividend, which is good. I'd have to wait a while for that, but it's still a good one. And the PE ratio is not too bad at 18.8, but I can't get into the ETF, so I ended up with DRD Gold, which is a 5.99% dividend, which is paid soon. The PE ratio isn't that good, but still, I think it's a okay company. You know, it's not doing too bad, and has a 25% profit margin. You know, if you look at it, it's not too bad. I'd like to think if we look at the balance sheet, we can see the cash on hand outweighs its total liabilities. You know, you can't ask for much more than that. I think if you want a hedge against crash, that's a good one. And there was one I wanted to put in, but it doesn't meet the criteria. Just so you know, Berkshire Hathaway doesn't give a dividend, but what it does do is, look at that PE ratio, 0.01. What it does do is share buybacks, and that's why I wanted to speak about it in this video, because I bought it at 160 in March, and around March time, and I bought it 160 last year. I bought it earlier around March time as well. I can't remember how much for. The funny thing is, if you bought it last year and you bought 5% of your portfolio, and then you sold out at 3% of it, because of share buybacks that they've done, you would still have the same amount of equity in the company. And this is why sometimes dividends are not always the best. Also, if you see with TSMP, they have bought a venue operator for 20 million. And that venue operator will use humble pay. So, you know, now. So, it's going to, there are some times when dividends aren't the best, but when you think that although it's gone up in value to 241, technically it's still the same value as when it was $160 a share, because of the amount of shares they bought back. And this is why Buffett doesn't agree with dividends. The company gets their shareholder gets taxed, and the company does. Now, I hope you've enjoyed today's video, and if you have any questions, put them in the comments box down below. Don't forget to hit the lovely like button, and if you haven't, don't forget to hit the subscribe button. I'll see you in the next video. That's all for today. Bye.